Hi, morning everyone. I'm Dede, Eyesan, the managing partner of Jenga Investment Partners. And with me is Anna Couri. Anna, why don't you introduce yourself for everyone?
Hi there, my name is Anna Victoria and I just joined Jenga and welcome. It's so nice to have you.
Yeah, Anna joined the UK team and she's an analyst and she's been reviewing the companies on the UK portfolio and also companies we don't have. So we're going to try and keep things short, simple, and quick. First of all, thank you for taking your time of your busy schedules for the conference. It should be a maximum of 1 hour. We'll spend the first 40 minutes reviewing the UK fund, the South Africa fund, the Jenga next year targets, and what we are, who we are, and what we aim to achieve. And then the final 20 minutes would be for questions and answers. Luckily, a few participants have sent their questions already. And once we answer those, we'll open up the floor for anyone to ask questions. So if you have any questions as we go on with the presentation, feel free to just type in your questions. Can someone please just type something just to be sure it's working? Yes. Okay, thank you. Yeah, I've got 3 highs. Let me just get this done. Okay, so yes, this is the agenda for today. We'll start off with a general Jenga structure, and then we move on to the South Africa fund. Then Anna will introduce you to the UK fund, the 4 companies we've already bought, and the outlook for the rest of the fund. And we'll talk about the strategy, some lessons learned over the last 1 year, and what we aim to do in year 2. And then the final bit, the questions and answers. And if there's anything you listen to today, please let it be this slide. It's really important you understand the disclaimers we have to share legally. We're legally meant to share this. So Jenga is a closed-ended, unregulated UK investment club. And the information here is not investment advice. And it's really important you don't call your brokers by the end of today and tell them to buy or sell any shares because of the information we've spoken about. And third, past performance is definitely not a guide to future performance. And investments do fall and rise. In March, our South Africa fund fell to minus 15.3 and it rose afterwards. So there's a real risk of losing your overall investments. And there's also also affected by exchange rates risk. Fourth, the material here is only directed towards club partners, so people who have invested in both the UK fund and also the South Africa fund. And lastly, we're unregulated by the Financial Conduct Authority, but we do plan on getting our license by the beginning of 2022. And we do not seek to provide any investment advice or charge any fees. So that's the disclaimer. I hope you do understand that. And please don't take what we say as investment advice. So we try to keep things simple, and our structure is, we want a structure to be simple so people can understand what exactly we do. We have the UK fund, which was started in September 15th, and we have the South Africa fund, which we started last year, October 15th. And the 2 bits where I want to focus on just on this slide is the Jenga briefings and the Jenga education. Now, the briefings, Anna and I write articles on companies, markets, economics, ESG, and all sorts. And we just want to share our current thoughts with people, how we're thinking about businesses, how we're thinking about the world. And last year we wrote about 15 articles, and we did receive quite good feedback from people who read, our reports. I think the most read report was L'Oreal. We had about 3,000 views on the L'Oreal article, and also had reviews from employees in L'Oreal. So we try to write about companies, we try to make our articles good, and hopefully it's a good way for people to see how we're thinking at Jenga. But one bit I'm really proud of in Jenga is the Jenga education. And that's because I realized while I was starting Jenga that there's a big gap in financial literacy for young individuals in South Africa and also in the UK. And I think a survey by the FT showed only 15% of students surveyed got financial literacy in the schools. So there's really not a module or in schools, especially the ones filled with people from low-income backgrounds on financial literacy. So over the next year, we'll be hosting lots of webinars. We'll be speaking to schools, and we'll be trying to teach students how to, manage money, save less, use less debt, spend reasonably, all these kind of things. And hopefully we can have a big impact on people, young individuals, in terms of their money management skills. So yes, this is a strategy, and regardless of where we're investing, these are the five attributes we look for. We could be investing in Japan, in Sweden, in South Africa, in the UK. We follow these five parameters. So just starting off with business economics, we want to look for companies that have good business economics. So these could be companies that generate cash or have a high return to capital or are just really profitable. And we want to find those kind of companies that have a good business economics over the long run. Second, we want companies with a strong competitive advantage. And competitive advantages can come in any form. We have network effects by many IT companies where if I share with my friends and my friends join an application, the business is stronger. So that's network effects. We have companies that have a high barrier to entry. Like, for example, I can't imagine anyone trying to compete with ShopRite in food retailer right now because of the barriers to entry in running a grocery retail store, especially in Africa. And third, when we find companies that have those two things, we want to find companies with an owner-oriented management. So these are usually companies that have a driven team, they're owner-oriented. It could be founder-led, it might not be founder-led. We feel the management is trustworthy and the people where we want to keep our money with. And when we find those three things, we then try to calculate the value of the business. So for example, when we say the margin of safety, if you think a company is worth £1, we want to buy it for 80p. And that gives us a margin of safety of about 20%. And it's quite popularized by Warren Buffett. So if you've read any Warren Buffett's book or watched his documentary, you would have come across margin of safety. But a less common term is margin of upside. And these are basically companies that can increase their valuations over time. And just a quick example is Amazon. Amazon started off as an e-commerce company, and now it has Amazon Web Services. And no one's valuation in 2000 would have predicted Amazon to have a web services. And that's a company that can have a margin of upside over time. And of course, when we find all four, we think they're rare. So when we find them, we concentrate a portfolio. I know it does sound like it's big, really risky having 12 to 20 companies, but we'd rather have 12 to 20 good eggs than have 80 good and bad eggs in our portfolio. So that's our strategy. And we try to keep things quite simple. So just to start off with the South Africa Fund, this was how we performed in the year. So there are basically 4 columns. The first one is the Jenga South Africa Fund, and that's how we performed at Jenga. Then we have the Jenga All Share Index, which is just, in layman's terms, it represents 99% of all the companies in South Africa that are listed on the JSE. You basically add all their market cap and divide them by the number of companies, and then you have the Jenga All Share Index. So every year, fund managers try to beat the JSE All Share Index. And on average, for the last 20 years, only 76% of fund managers have outperformed the benchmark, the JSE All Share Index. And it's a very tough benchmark to beat because Naspers, which is, I think, is the best company, is the largest company in Africa, and it's one of my favorites, is 20% of the fund. And it's very difficult. I mean, most funds are not allowed to have up to 20%. So most funds are under concentrated in Naspers, and that makes it very difficult to beat. And then we have the JSE Top 40, which is just the market cap of the 40 biggest companies in South Africa. That has significantly outperformed the JSE Mid Cap, which represents companies between 41 and 100. So the companies in the middle aspect of the spectrum, and usually between 1 billion rands and 10 billion rands. And just looking at the table, you can notice that the JSE Top 40 outperformed the JSE Mid Cap. And that's because the mid cap and small caps were more sensitive to the investor sell-off over the last 10 years and also this year. in South Africa. So the mid-cap companies have, some of them have not actually been bad per se operationally, but they've just been sold off. And the Jenga South Africa fund is significantly exposed to the mid-cap and also the small cap. I think we have 8 companies that are classified as mid and small cap. So we're exposed to that risk. And as you can see, this year, the mid-cap was fallen by minus 20%. And yeah, it's been quite tough. But yeah, the year we had a good performance. Just going on Citywire, only 2 funds in South Africa did better than us for the last year. So there's room to improve. But we're pleased with the results. But as I always say, 1 year is too short to judge an investment strategy. You need at least 3 years. So we have to keep doing what we're doing for the next 2 years and ensure over the next 3 years or over the next 2 years, we can even do better than we have done this year. So our fund returned 15.3% to the investors my friends and family who invested last year. And hopefully we can keep this and keep growing the assets under management and also improve our performance over the year. So that's basically the breakdown of our performance in South Africa. And also some people have asked, why did we choose South Africa? Well, for me, I always wanted to start a fund in Africa. And, before we selected South Africa, we had 6 countries on a short list like Nigeria, Kenya, Egypt. Well, we were thinking about, certain things. We wanted a country that we thought was liquid. So even if we have to grow asset under management, we're not moving the market or finding it difficult to buy or sell. There are companies in South Africa that are worth more than $1 trillion rands, like Naspers, for example. So it's quite liquid. It's had its political risk and problems over the last 10 years, but we think things are improving and we think the prices are significantly discounting the real intrinsic value of the companies. So we realized there are going to be a lot of opportunities in South Africa, but we definitely had to have thought really deeply and looked really deeply in terms of finding opportunities in South Africa. So we're comfortable investing in South Africa. We think we're going to be doing this for the long term. I'm excited about the companies we find on the JSE. There are roughly about 331 companies listed on the JSE. So we're finding lots of opportunities, a lot of investment opportunities, but it's going to be really difficult. It's going to be very difficult, but we're looking forward to the challenge. So hold on. So we classify our investments with 4 key aspects. So the first one, as you can see on the top of the page, are compounders. And as we'll explain, compounders are basically companies that can grow really quickly. They are asset light, they are expanding in South Africa and also outside South Africa. They have their own competitive advantages and they really fit our investment philosophy. So we have the compounders, and we have 5 out of the 13 companies in South Africa as compounders. Just on the left-hand side, there's CarTrack. CarTrack basically is a company that lets you track your cars. And when you think about the crime rates in the region, it's important, to have this kind of security, being able to track your cars. Companies like Lafarge, Dangote, they all use, car trackers for their fleets. So we call it fleet telematics, and they're able to analyze the data on all these companies, on all their fleets. So basically that's what they do. And it's a profitable business. It's software as a service. So every month people pay a subscription, and that means the revenues are not lumpy over time. So it's consistently growing. I think even since the lockdown started in South Africa, it's grown its revenues, profits, and cash flows by at least 15% in the last 6 months. And that's really impressive considering where the global economy is and the difficulty we're facing overall. So CarTrack is an amazing company. It's founder-led. Zach Lister is a superb CEO. He owns about 68.5% of CarTrack, and they're doing quite well. It's the largest company on our portfolio. And as you can see from the data, basically the data below are just financial metrics we find important. ROC is just return on capital, and that just measures the profitability of the company. The FCF is the free cash flow margin, and that's how much cash a company generates over the revenue. So the higher the cash, the better we like the company. And then the EBIT margin is just the operating margin. So that means when we remove revenues minus operating cost, what are we left with? That's the EBIT margin. And the higher the EBIT margin, the better we like a company. Then there's the debt to capital. We don't like companies with too much debt, although you would see we have some companies with high debt, and that's a different type of investing we do. And then EBIT growth is basically the growth of EBIT. So you can see Cartrack is doing quite well in all metrics, and we're pleased with them. Naspers, I think Naspers is probably one of my favorite companies in the world. And it initially started, I think, between early 1900s as a newspaper magazine company. And now it's changed, newspaper publishing magazine company has now it's changed over time. Now it's an investment company and invests in leading internet companies. And I think Naspers has made the best investment in the world ever. So in 2001, they invested roughly $30 to $40 million for a 42.5% stake in Tencent. And Tencent is basically the Facebook of China, and they have the biggest global gaming community in the world. It's a remarkable company. And now their investment of about $30 million is now $200 billion. So if we at Jenga can make those kind of investments, I would definitely be super pleased with our performance. But that's the kind of company Naspers is. And even now they have investments outside Tencent. I think Anna was just telling me about iFoods in Brazil, and Naspers have a 55% stake in iFoods, and iFood is basically the Uber Eats of Brazil. And it has an 86% market share in Brazil. And that's a really big economy. So it's really glad to see Naspers making investments in all the types of companies. And we think they're going to keep growing. I know the operating margin and the metrics look really poorly, but that's because it's an investment group. So we don't really measure it like how we would measure Cartrack. We think more about the net asset value, and Naspers is currently at a 52% discount to its 10, or to just its stake at its 10 cents. So it's a wide discount, and there's lots of value over years. I think this morning, Naspers announced they were going to buy back shares, which is really good for us. And then we just want to move on quickly because of time. There's Alaris Holdings. Alaris are a niche manufacturer in radio frequency and broadband communications. And I know they're listed in South Africa, but they're really global. So they operate in Finland and USA. They have strong margins. The company we really like was actually the first company we bought, and it only took us 30 minutes to make a decision on Alaris, and it so far paid us well, and we're pleased with Alaris. And by the way, Cartrack has been a best performer among our current holdings. I think its share price has appreciated about 68% for us, and that's really good. So we're pleased we made a good investment in Cartrack. And just to move really quickly, I'll just briefly talk about these two companies, but these are other two compounders. PBT Group is a data analytics company that was quite big in Africa, but then it's now expanding to Europe, and Europe gives PBT higher margins. So we're pleased they're making good decisions. We really liked their last annual report. Well, it's led by two amazing women in management, CEO and a COO, who are doing quite well to transform PBT into the next leading company in data analytics. And one of the clients is MTN, which is another company we own in South Africa fund, is also doing quite well. And then there's Caprec, it's basically capital appreciation. It started in 2015 as a SPAC, and now it's it's a fintech investment group. And they have some of the leading fintech companies in South Africa. And one of the companies were the first Amazon accredited web services provider in South Africa, and I think that's an amazing accomplishment for capital appreciation. We really like the margins. We think it's a very good company that has lots of growth potential. And when you think about COVID-19, no one really wants to hold cash right now. So all the small businesses and even the large businesses are all trying to adapt quickly to things like Apple Pay and all sorts. And that's the kind of services capital appreciation provide. And yes, we do like them. Moving on, we have MTN Group and ShopRite. These are turnarounds. This is the second class of companies. When you look at the debt to capital, that's the key difference. You can see it's quite high, 62 and 65.1%. It might be, it's a big stretch, but we think they're reducing it. They both had missteps for the last 5 years. MTN, for example, I think in 2016, they had a $5 billion fine from the Nigerian government, while ShopRite, which obviously put the management off and caused lots of missteps, while ShopRite, for example, made a lot of missteps in terms of where they were expanding to. They expanded into Nigeria. We think Nigeria is pretty much impossible to run a retail company. So they've now decided to discontinue the Nigerian operations. Oh, there's a common theme here in Nigeria. So yeah, that's the theme we have in turnarounds, but they're basically former compounders who are now doing better and making their economics much better. MTN have a new management, they're reducing their debt, they're increasing cash flows. They announced their results earlier today and it was all really good. They're also listing local shareholders, and the benefit of listing local shareholders is if they have legal problems in, let's say, Nigeria, Ghana, or Uganda, they have, legal lawyers on board who are able to support the company overall. So it's good they're doing that, and we're pleased with the turnaround companies. So this is probably the most difficult section, or the most difficult investments we make, cyclical companies. And this is just companies that are pretty much commodity-based and move in cycles. So Afrimat are iron ore and construction. So things used in supporting the construction industry, they are experts in that. And I'll pretty much say Afrimat are probably the best capital allocators in South Africa. We're really pleased with Afrimat's performance over the years. They have a high return on capital. Can everyone hear me? And could you note if you can hear me? Okay, thank you. There's Meta Investment. Moving on, we have Meta Investments, and Meta are one of the biggest players in energy storage and automotive parts. So things like braking lights, radiators, they produce all that. And Meta actually have exclusive contracts with companies like Ford, Mercedes-Benz, and lots of automotive companies in South Africa. And they also operate outside South Africa. So they operate in Eastern Europe. So countries like Turkey, Romania, and Russia, they have small operations there. Now they're expanding to renewable energy storage, which we think is the future, and they're doing quite well. So Meta is a great company. Well, it's improving. It's been a worst performer on the South Africa fund, but we still see some opportunity in Meta. And there's a potential Meta will be able to sell half of its business for more than its market cap, which will unlock lots of value for shareholders. But we remain optimistic on Meta. And Baldwin, which is just 0.6% of our portfolio, is pretty much a property developer in South Africa. They have 1 to 3 bedroom apartments in South Africa, and we were really pleased with the performance in South Africa. It's definitely somewhere I would love to live if I do move to South Africa. But yeah, we like the property portfolio, we like their financials, and we think they're doing quite well. I'm going to speed up with the stalwarts, but this is the last group of companies we have. There's Primeserve, British American Tobacco, Advotech. Primeserve are human resources, so things like how to hire, how to fire, how to go about human resources. That's what we do. We think they will be resilient over COVID-19 because we think their services are quite in high demand, so we expect them to do quite well. British American Tobacco is a leading tobacco company in the world. It's also listed in the UK. As you can see, the operating margin is really high, 43%, and this kind of fits in well with the stalwarts theme. And just to go back, stalwarts are basically companies that are growing much slower than compounders. So in 10, 20, 30 years ago, they were compounders, but then now they're much growing, like probably 5, 6, 7%. And we basically think they're massively undervalued. So that's why we invest in them. It's more of a value investing philosophy when we invest in stalwarts. And Advotech are the largest private education providers in South Africa. They're also growing really slowly. We think there will be resilience over COVID-19 because their services are still in demand. We like the portfolio of secondary schools and universities. We're pleased with these companies. So these are the positions we exited. We left Impala and Northam. We've bought 16 companies, we've left 3. We bought Impala and Northam in the year. Impala and Northam returned about 75% for us, which was really good. They fell really rapidly in March when COVID-19 broke out in South Africa because people thought they were going bankrupt. But we saw the buying opportunity, so we bought shares and were able to we were able to provide a good return for shareholders. But we sold shares in Northam and Impala to buy shares in even more undervalued companies. So that's why we sold shares there. And then there's CAP Group, which we lost money in. We lost minus 8.4%. And that was probably my error. But we've learned a lot of lessons in CAP industry. We think it's a very good company, but the commodity it operates in, so polymer and in the logistics business and textile, we thought they were not going to be doing well in COVID because of the climate in South Africa. So it was probably us buying too early. So we sold shares there, but we could possibly buy them in the near term. So that's it for the UK, for the South Africa fund. The UK fund is the same philosophy. It's benchmark. We started in September, so we don't have any overall, we don't have any results yet, but next year we will have a result and we hope it's also really good or even better than the South Africa fund. But we buy shares in prime and secondary stock. So it's about 6,568 companies listed in the LSE and AIM. AIM is basically the alternative investment group in the UK. And these are much smaller companies that are fast growing. So we have companies in AIM. And we apply the same investment strategy and we think more global because there are companies in the US, Sweden listed on the LSE and we can buy shares there. So we think a lot more global comparison to the South Africa fund. And I'll let Anna introduce you to the companies we've bought and she'll just try to explain why we bought them and all sorts. So Anna, feel free to come on board.
Absolutely. So far we've invested in 4 compounders, like Dede has explained. And let's start with Medifast. They're an amazing fitness and weight loss community company, same word for them. And for the last 4 years, they've been on America's Fast and Growers list. They've been even ranked 33rd in 2019. So their business model is based on direct selling and of course, fitness products. What makes them special is that they rely on coaches. So they've got coaches who charge like varying amounts of fees to coach people who in turn, they can train more coaches and that's how they compound over time. So 90% of their Optavia coaches used to be clients beforehand. And when looking at their financials, as you can see, they're extremely healthy. And at the moment, we are super comfortable with the valuations. And covering the pandemic, they have been very strong. And even during the lockdown, they have managed to expand revenue and even somehow increase marginally their operating income, even if they had to cut a few costs here and there because of the pandemic. So now Facebook, they're our biggest company in our UK portfolio and we love them. That's because we think they have one of the best business models ever. And simply put, they connect the world, excluding China, of course. So Facebook has 2.7 billion users. And we all know that they own the 2 giants, WhatsApp and Instagram. And they have recently announced that they'll be expanding next year into cloud gaming. So that's one of the biggest trends we see for 2021 in gaming, as well as their new niche virtual reality called Oculus, which you may be familiar with. However, talking risk, Facebook is somewhat prone to anti-competitive sanctions and scrutiny, but we don't think that will be an issue. And that's because there's a lot of competition in the social media and advertising industry. And well, they still can't call themselves a monopoly because they compete with Google in advertising revenue. That apart, we really like the people on top of Facebook. So developing their operations, they're very focused on their development. And even if they're our biggest company, they're still growing by the day because we think they will be on top of technology in the next couple of years. And that's why we believe in them. So now we're going to move on to Garmin. Garmin is a navigation devices company, and they are a world-class firm in navigation systems, and so GPSs, so global positioning systems, which we all know, of course. Garmin operates in 5 main sectors, so fitness, outdoor, aviation, auto, and marine. And we mostly like their fitness sector, which accounts for 28% of their total revenues. And we know that for real athletes and sports peoples, their favorite smartwatch and tracking devices for cycling and for running. And that's because their products are so accurate in fitness performance. Talking financials, they have no debt. They're a non-lease debt-free company with an extremely strong cash position, and they are growing. Except for their auto division, which is under a lot of pressure due to strong competition from Google. We know that that could be a potential risk we are aware with the company, but we are super optimistic on their performance in the next couple of years. And finally, the fourth compounder company we have is Balco. So they're a Swedish company who make balconies. And at first, we never thought we'd be investing in Sweden. But if you look at Balco, they are the market leader in balcony solutions in Sweden, and they also operate in other Nordic countries, so Finland and Norway, as well as Denmark, if I'm not mistaken, as well as Germany and the UK. And we've noticed that their focus on niche balconies has given them a competitive advantage with their clientele that has been very faithful to their balconies from the beginning to the end, so repairs and everything, innovations. And they work with Swedish building contractors who operate in both new builds as well as the renovations for their products from the past couple of decades. Well, as you can see with their metrics, they're extremely healthy and they are growing quite quickly. And they are aiming to expand revenues by at least 10% a year, having minimal debt and very solid margins. And those are the 4 companies we've invested in the UK. Now moving on to Dede.
Yes, thank you, Anna, for talking about the UK companies. I just realized I forgot to talk about the risk with compounders. So even though we like compounders, the problem with compounders is sometimes the markets can be overly optimistic about their growth potential. So you see them trading at really high, valuations. So we have to be very careful about how much we're paying for compounders. And we think the ones we've bought are, are at a good value in terms of our judgments. So that's why we've bought those 4. But yeah, that's the key risk with compounders over time. So the lessons we've learned in our first year, the first one is try not to predict, because we can't really predict where the world is going to. I know that sounds ridiculous for an investor, but we found a lot of benefits in just observing where the world is right now. So right now, COVID-19, it's really difficult for businesses operating, but we're still finding opportunities when we think about the world right now. So for example, lots of companies are, trying to put themselves online. E-commerce is growing really quickly. This high demand for services in IT, like, outsourcing, HR, and all these kind of things. So we're just observing what's happening today, and that's how we're able to find opportunities for, the short, medium, and long term. So we try not to predict. And if you're trying to predict when AI is going to be implemented in every company, we can't do that. So we just put that off. Second, we lost money in cap industries, and that was because we had problems with timing the changes in supply for polymer. So we want to, with commodity companies and cyclical companies, we want to have a good understanding of the demand and the supply. That's pretty much, that's like 80% of the homework we need for cyclical companies. And once we have a good understanding of that, then we can have a good understanding of the company and the valuations. So that's a lesson we learned in second year. Third, it's important to think global. When we were buying shares in iron ore in South Africa, we weren't actually thinking about buying shares in iron ore. We were thinking about the demand for steel in China, and the main material used in steel is iron ore, and realized that there was going to be a very strong demand for steel and iron ore in China, and that was going to drive prices for iron ore up. So we weren't even thinking about Afrimat or iron ore South Africa. We're thinking about China. And by thinking about China, we're able to find investment opportunities in South Africa. So you see, the benefit of being global is there, and we try to be as global as possible. Fourth, and a popular theme in investing is, are we quality, value, growth investors? What do we do? Are we value? Do we buy by P ratio? We think we're all 3, and I think that's where we're unique. We won't say we're just value or just growth or just quality. We're a combination of all 3. And that means we look for very strong businesses that are undervalued and growing. In the UK fund, all the companies we've bought are growing revenues, cash, and profits by at least 10%. We think they're well undivided, and we think they have very good business economics and competitive advantages. Fifth, it may be obvious, but we still make the mistake, and lots of people make the mistake of overpaying for stocks. So again, margin of safety, we want to buy shares that ATP, that are worth £1 for ATP. We don't want to buy shares that are worth £1 for £1.20 because we're overpaying and it's going to go down over time. So we want to avoid overpaying for stocks. And sixth, and the last and final lesson is watch the unloved. And that basically means companies that people, investors don't like at the moment. So companies we hate in sectors and industries we don't like. And we learned a lesson in South Africa because Sasol, which is one of the leading chemical and oil producers in Africa and also have operations in USA, fell by 90%, and everyone thought the stock was going to zero. But we did our calculations and we realized there's actually some equity left, but we didn't buy because we were worried about it's been going to zero. And after the fall to 90%, the stock rose, appreciated by 300% afterwards. So you can make money from even companies people think are going bankrupt. And that's an important lesson for us to learn. And that's one we're going to keep reinforcing over time. So yes, we're down to the last two slides. These are next year targets. The UK fund wants to outperform the benchmark and do better than 8%. The South Africa fund, same thing, outperform the benchmark and better than 6%. The lower hurdle rate is because we think the UK benchmark will do much better than the South African benchmark over time. So that's why we have the hurdle rate of 6%. And then there's the Jenga education. We want to have at least 8 webinars with students in A-levels, sixth form, and universities on money management and financial literacy. It does bring me a lot of joy. So we want to, keep Jenga education strong over the next year. Then the Jenga briefings, we posted 15 reports last year. We want to do another 15 and even better quality reports. And then the last bit is converting into an investment trust. Right now we're an investment club, and that means we're not FCA licensed, and we want to become FCA licensed. And if we do become FCA licensed by next year, we probably would be the youngest run fund in the whole of Europe. And I think that's extremely ambitious from us. And I'm not entirely sure of many or any other fund any other fund managers who's gone from university to running a fund. So it's an ambitious target for us, but we think it's doable. We know there are a few gaps we have to fill, like experience, but we are trying our best to learn from more experienced people and learning from our mistakes. So we're working on what we feel are weaknesses, and we think by 2022 we'll be ready for a transition into a UK investment trust, and hopefully we get the license and we're able to raise a lot more money and actually become money managers. So those are the targets for the next year. And I look forward to sharing this journey with you. And the last slide before we go to the questions, these are our 2021 opportunities. So this is where we see opportunities for next year. Roughly about 8 places. We're not limited to just these 8, but these are the 8 we wanted to talk about for this presentation. And do you mind explaining the opportunities in gaming and home improvement? Then I'll do the remaining six after.
Absolutely. So the gaming sector is one of my favorite industries, personally speaking. I'm sure it's the same for Dede. If you look at 15 years back, the number of video gamers was about 200 million, which is already decent. And now it's at almost 2.7 billion people. And unsurprisingly, during the pandemic, gaming has become one of the top pastimes. And this $160 billion industry is going at an impressive speed, mostly due to 3 reasons. So that's 1, technological advancements, so offering amazing increase in quality and hardware power. 2nd is internet, allowing new features, not to mention the potential of 5G in the gaming industry. And that's why we think that this technology is opening doors for more game studio productions, streamers, and developers. And we are super optimistic about the industry. And now moving to home improvements. It's actually one of the fastest growing retail industries, as home improvement spending has been growing at almost double the rate of the rest of the retail sector. And what's propelling the home improvement sector? Well, first of all, the pandemic, so pushing people to spend more time in their homes instead of spending money in restaurants or holidays. Second is the growth of home values in the UK and the US. And third, according to Harvard Center for Housing Studies, 40% of the US's 137 million homes are now at least 50 years old, and older homes need more repairs, and it's the same in Europe. So that's about it for these two sectors.
Yeah, thank you. And just looking at the overall aid, so there are two main themes going on here. There's innovation and there's health awareness. So these are the two main key themes here. And, just starting off with innovation, liquefied natural gas is, it's a gas used, a gas in the energy sector. And when we look at the energy sector, that's where we really find opportunity there, and also in renewables. And just to dig deeper into the new, liquefied natural gas sector, where we really see opportunities is in marine fuel. So I think early last year, the EU regulation body announced they want all shipping companies to drop sulfur oxide emissions from 3.5% to 0.5%, roughly around there. And natural gas emits less sulfur dioxide than coal or oil. So companies are shifting their fuel to natural gas. It's lighter, there's less shock of combustion and burning. So that's where the opportunity is there. And we're finding attractive companies who help these marine companies install containment membrane systems in the shipping companies. So that's where we really find opportunities. Second, in renewables, renewable energy storage, people are aware of the change in climate change. Climate change is a big thing. So a lot of people want to install solar PVs in their homes. They are a lot better than your coal-powered homes in the UK or elsewhere. And also this comes in with technology, because even with like a company like SolarEdge, which is one of the leaders in renewable energy storage, you're able to track many things like how much bulb energy you use. You can track it from your phone every day. So you're able to see what's efficient and what's not efficient. So that helps you save cost over time by being more efficient and using less energy. The IT software, innovation again, when we think about COVID-19, lots of businesses are trying to adapt really quickly. So companies are outsourcing, middle and back office services. And now you have companies like Primes that we're talking about, and other companies who are now trying to build softwares that lets companies, work on things like human resources or chat boxes in websites, to speak to clients, all those kind of things. That's where we really see opportunities in IT software. And then the last three, I want to combine industrial Internet of Things and semiconductors. So basically, semiconductors is the heart of the future of Internet of Things. And when we look at it from a more industrial perspective, when we look at warehouses, plants, it's important for all these warehouses to track what's going on, make things a lot more robotic, or reduce costs, become more automated. And that's where the opportunities in combining technology and industrial sector really comes in. And we see companies that provide these services doing quite well financially. So you can expect us to buy shares in a few of them over the next 1 year. And then moving on, one of my favorite sectors, because it's agriculture and I really love agriculture, is salmon farming. And most especially in Norway and in Chile, which are the largest salmon farmers in the world. And I think about 2019, about 3.8 million tons of salmon produced globally. And in the last 10 years, in the last decade, a company like Salma, which is one of the largest in Norway, has increased their revenues and profits by at least 200% in 10 years. And I think that's remarkable for agricultural companies. You don't really find that, consistent growth. And that's because salmon is healthy, is really healthy. And I remember when I was like 5 and 6 and my mom tried to, force me to take omega-3 oil, krill oil, and salmon is rich in all these things. And we see people also becoming more aware about the benefits of salmon. And when you compare salmon to meat, it retains 31% of its protein, whereas meat retains only 15%. So there's a big opportunity in salmon, and that's our final opportunity for 2021. So you can expect us to invest in some of these companies who we feel are aligned with these themes and these industries. And thank you for the presentation and for taking the time out. Now we'll start answering questions. Feel free to send in your questions. Just because of time, I will try to answer these 4 we got from people who sent in questions before the conference. The first one: where do you see Jenga in 5 years' time? First, next year we want to transition into an investment trust, and 4 years after, we want to have one of the best returns globally and in South Africa. So that's our target, and we try to be as transparent and as clear about what we want to do. We talk about all our stocks and everything. We want to be as transparent as possible. And that's where we see ourselves in 5 years' time. We think we have the ability to be one of the best investors in the next 5 years globally. So our efforts in terms of managing our time, skill sets, resources is in delivering Jenga into where we think it will be in 5 years' time. So that's where we see Jenga 5 years. And we also want to improve on our Jenga education. We hope we can, have a hub where students can, talk with us, or even a software where people can, learn money management skills from their homes and are able to practice investing for free as well. I think that would be really cool, and that would be a good idea for Jenga education. Second, how will the rise of passive investing affect active investors like us? So for those who may not be familiar with passive investing, these are basically ETFs. So they're like a fund where the manager doesn't really have to do much buying and selling. It's just a replicated investing of probably a benchmark or an industry. And for the last 10 years, they have outperformed active investors. So there's a big risk for the future of active investing, but we think the world still needs active investors. First of all, passive investing will never be able to be activist compared to active investors. For us, we're active in terms of buying shares, but we also want to have a role in the companies we invest in. So we want to have an active role. For example, if we feel ShopRite is doing something wrong, or we feel we're not happy with the management, we can, speak to them privately. We can, vote in shareholder meetings. We can actually be active. So that's one way, I think, that's one edge we have over passive investing. And 2, we aim to be the benchmark. In our first year in South Africa, we did pitch the passive investing strategy for South Africa by 15%. So we still think we can outperform passive investing. And I know people talk about the rise of AI a lot, and investors becoming AI oriented. Well, I don't think AI has a role in Jenga. It does have a role in research and in understanding companies, but not in picking stocks. Picking stocks is 100% human. Picking stocks is about using common sense, logic, facts, and being rational, and also understanding people. And we think the human brain has an edge over AI in this. So the way we invest, we like being human. We like being active. So that's how we see active investing over passive investing. The third question: will running the UK fund affect the South African performance? I don't think so, because again, we think global. Looking in the UK helps us understand South Africa better. And I just gave an example of how evidence from China helped us in investing in South Africa. And we find lots of synergies. A company like British American Tobacco is listed both in the UK and in South Africa. So that's another area that we benefit from managing both funds. And also we're building a great team for the UK fund, and they joined us in July. And probably in the next 1-2 years, someone else might join us, depends. But we don't think it would affect us, and hopefully a result says that. And the last question sent in was, what's your view on the South African economy, and how does Jenga deal with the political risk? Oh, that's a tough one. For the last 10 years, the South African economy has been in a difficult place. Political risk, state-owned enterprises being overfunded. We have things like Eskom, South African Airways, and companies have also been struggled over the years, especially those who have taken on dollar-denominated debt, and also consumer confidence and has been badly beaten down. So there are lots of risk and threats in the South African economy, but we think when we look at the prices of the stocks, we think things are a bit overpriced in. So we're looking at things more from a value perspective, one, and we still see growth opportunities in the South African economy. So just talking about Cartrack, which is growing really quickly. There's Naspers, there are lots of companies who are still listed on the JSE, which we think can be a hedge to South African economy and the political risk. And the last statement is also try to buy companies that are not too tied to the economy. So for example, the business drivers of Cartrack are not necessarily the economy. So the economy can be doing quite badly, and we have companies like Alaris or Naspers or Cartrack, which can still do well. So those are the kind of companies we want to buy stocks in, and that's where we have an edge in. Anna, would you have anything to add?
Not for the moment, thank you.
Okay. I'm just going to open up some questions that have been sent, and just give me a second. Okay, so the first question, just to clarify, what do the numbers in the purple banners represent? For instance, 14.4% for Cartrack. So that's the portfolio weighting of Cartrack in the portfolio. So Cartrack, as of when we wrote the presentation, was 14.4% of the portfolio. And I think NAS was about 13% and M10 was 13%. So that's what it represents. And thank you for the question. And I should have mentioned that earlier. Second, given the cycle, when are you expecting to sell your stakes in Afrimat and Baldwin? We're still quite optimistic about iron ore, so we don't see ourselves selling Afrimat anytime soon. However, every day we look at the facts and what's happening in China, Brazil, and Australia, who are the big drivers of demand and supply in iron ore. So as long as that's doing well, the iron ore price is doing well, and Afrimat are also able to, allocate capital really well. We think they're still going to do well, so we don't plan on selling shares in Afrimat soon. For Baldwin, we actually just started buying Baldwin, and we think we're going to buy more over time because we think what they offer, the 1 to 3 apartment bedrooms in places like Johannesburg and also expanding into Cape Town, we think there's going to be high demand over time, over the next 5-10 years. So that's where we see opportunity for Baldwin. Third question, why will the same strategy for the South African work for the UK market? Is the marketing environment the same and maturity? I think that's a very good question, but what we've realized is human emotion drives markets, whether you're in South Africa, UK, Japan, Sweden, it's all the same. And it's all about being able to find undervalued companies. And companies can become undervalued for any reason. It would be because the business is struggling itself. It could be because of margin calls where investors have to sell the loans from brokers to fund their loans. So overall, markets are driven by emotions a lot, largely by emotions, and being able to use the same strategy that allows apply the same strategy in South Africa and also in the UK. But obviously, the businesses in both companies are different. So even though our methodology for assessing companies are the same, what we look for are different. So in South Africa, we're looking for companies that are strongly undervalued mainly, whereas in UK, we're looking for companies that would benefit from the key themes we see in innovation, health, and other things. Good question from Joel. What are the challenges associated with being a young fund manager and with a primary makeup in university students and recent graduates, especially credibility building? That's a good question. I think about credibility in terms of 2 ways. So I think I use a formula. Credibility to me is time plus consistency. Over time, we think if we're able to be consistent, people would see what we're trying to do. And if we're consistent with our returns, so if we're able to compound 15% every year, I hope, for the next 10 years, then over time, people will be able to see that, we actually know what we're talking about, or we know what we're doing. And we aren't just your university students who are just gambling on the stock market. So that's how we think about credibility. It's obviously tough, and we obviously have to work extremely hard for people to see that we are credible, to see that we know what we're doing. And that's why we always see me posting on LinkedIn and sending the Jenga briefings. But we're going to keep doing that. We're going to keep working towards it. We don't think it's impossible, but it will require lots of work from us. Anna, do you have anything to add there in terms of being a student and investing in the stock market?
I think in general, it's more about learning from mistakes than anything else. So I'm still learning the mistakes I'm making here with Jenga. So that's how I think we'll be building credibility.
Yeah, that's a good answer. What put you off going into the Nigerian market? We wanted companies that are liquid, one, and we also wanted optionality. So in South Africa, we see 331 companies listed on the JSE. In Nigeria is much less, and the companies are a lot more agricultural, manufacturing based. So it was more about the optionality and liquidity for us. And we weren't particularly pleased, optimistic on the political situation in Nigeria and also the consumer confidence. I mean, we could still make money in Nigeria, but we don't want to invest everywhere, so we have to pick the best place we see, and we decided South Africa was the best place for us. Next question, how do you guys know you're buying value if you don't do any financial modeling? Yes, so that's one thing we don't do. We don't use spreadsheets or Excel. And I think Anna was surprised when I told her to delete Microsoft Excel from her laptop because we're never going to use it. But we think, okay, overall, we think finance has become a lot more financial modeling and financial engineering focused rather than actually understanding the business. When you understand the business, when you read about the annual reports, you read about the business, you think about the cash flows, you can mentally forecast or mentally calculate the present value of future cash flows without doing much Excel work. And sometimes we just see value instantly because you see a company trading at, for example, a P ratio of 5, it has no debt, revenues are growing 10%, growth is growing 10%, the business is solid with strong competitive advantages and really solid management, then we think the value is there. Then we'll buy shares there and wait for the market to realize. So that's how we find value without doing financial modeling. How can one invest in your SA fund and thoughts on PrimeZev? For the SA fund is currently closed, but in the future, when we do convert into an investment trust, we will list the South Africa fund as a unit trust in South Africa under RAND terms. So you'll be able to just go on a website and buy shares there, hopefully. So that's how we could buy shares on South Africa fund. What are our thoughts on PrimeZev? I think PrimeZev was a deep value play. So I think it's about a valuation of, it has a P ratio of about 4 times. We think it's quite strong. We think even if the economy falls, there will still be demand for human resource services. We also don't think it's perfect, but we think the margin of safety in PrimeZev is strong enough for us. Okay, we have time for 2 more questions. What are your thoughts on investing in real estate? So we try to, we work within a circle of competence. So these are basically industries we understand, industries we can value, industries we understand the competitive advantages and the differences. And at the moment, we don't think real estate, especially REITs, are within a circle of competence. So right now, we're not looking at real estate. There could be opportunities there, and we've also realized we don't have to have every industry within a circle of competence to make money on the stock market. So we try to work within sectors we have a competitive advantage in terms of understanding the business. So that's what we think about real estate. There are definitely opportunities there, especially in Africa, but we're learning, but right now we don't have a good understanding of how to value rates. And if you look at South Africa, for the last 1 year, all the rates have fallen by at least 50 to 60%, although we did see opportunities in one REITs company, which is a storage facility company, and they operate, so it's called Storage, and they operate in the UK and in South Africa. We think storage is unique because if you think about it, university students in London, after summer, they want to put their stuff somewhere and they all go to storage facilities. And the demand for storage is also really good because even when you have a recession, there's still a strong demand. Actually, when you have a recession, people are moving jobs or leaving jobs, they put the stuff in the storage place, and that's really good for storage companies. So we did see an opportunity there, but we were not really pleased with the margin of safety in storage, so we decided not to invest. And that hasn't really been a great decision for us, but we see one or two opportunities in real estate, but generally we try to avoid real estate because we don't have a competitive advantage there. Okay, we'll just take 2 more questions for now. What's the role split between Dede and Anna? Anna, you could talk about your role.
So my role is reading, basically doing some research, but my focus is on the UK fund, whereas Dede covers mostly the South African fund, and of course helps out and gives some guidance for the UK.
Yeah, so that's how we split the role, and we talk pretty much every day at 3 a.m. I send them messages on the new article on what's going on in the UK, on how Facebook's quarterly updates was, and all this kind of thing. So we are able to work. She's in Brazil right now, but we're still able to communicate, thankfully, for Zoom and WhatsApp. So that's how we split the roles generally. And then the last question for today is, what are your thoughts on buying non-equity assets like commodities, bonds, derivatives, cryptocurrency? You can make money in any of these asset classes, but we focus on equities because that's where we have first of all, that's within a circle of competence, and 2, that's where we have a competitive advantage in. We have exposure to commodity companies, but we prefer investing in commodity companies because they operate with operating leverage. So, for example, gold can go by 10%, but the shares for gold producers will probably go by 100 to 200%. And that's because they operate with operating leverage. So that's why we prefer the commodity companies rather than the commodity itself. For derivatives, we don't use leverage, we don't use derivatives, we don't short sell, we don't use swaps or options, we just buy stocks. So we don't use derivatives at the moment. For cryptocurrency, it's not within a circle of competence. I know Bitcoin is hot right now, but it's just not something we feel we can value. So we just don't do it. We're really strict on what we buy and what we don't buy. And that helps us. That's our risks management process. So lots of people, well, not lots, some people see the next big thing and they want to invest. We sometimes take a step back and try to understand what exactly it is before we invest. Right now, we can't really value Bitcoin, although we do like blockchain technology, but we can't value Bitcoin, so we just wouldn't buy Bitcoin or anything cryptocurrency. Overall, thank you so much for joining us today. I'm really delighted to host the first Jenga conference with Anna. Hopefully we have one next year. And in the midterm, it will be in person. And I know it's been a very difficult situation for everyone because of COVID-19. Some people have gotten fired. Some people have had to look for new jobs. It's really challenging, and no one can predict no one could predict where the world would be this way in 2020. But I hope you're able to, spend the rest of your day productively, enjoy the rest of your day, and the weekend goes well for everyone. And feel free to drop us an email. You can message me, message the Jenga email, and we'll definitely reply if you have any more questions or any pressing questions you feel should be answered. We're definitely happy to take more questions after the presentation. And yes, thank you again. And thank you, Anna, for joining us today. I think it's about 8 a.m. in Brazil. Yeah, so thank you for joining us. And I hope everyone has a good day. Thank you.
Thank you so much. It was a pleasure having you guys. Have a good day.